Greetings, everybody. This is Jeff Scott, and welcome to this week's edition of my top-down review. First, um, it's a great time to start remembering the folks that gave their lives and put time in the service to support and help build this great country. As we go into Fourth of July weekend, they should never be forgotten. Um, and I also like in days like this to think of folks that really made a big influence on me, besides my own parents, but also people like Ian Woodward, whose work I try and emulate, as he was such a great teacher, friend, and scholar. So, welcome, and let's go and take a look at the market. Now, as you can see, I titled it Tech Rex, Healthcare Gets the Flu and Market Rotates. Because I think in one sentence, that tells you what's going on. We can shut it down and go enjoy the pool. So I think pretty much everybody knows or felt that with the market. But let's see if we can't learn something that might be helpful in our trading this shortened week, half day on Monday, no trading on Tuesday. As always, this is for education purposes only. Anything I recommend is in the spirit of education, should not be considered investment advice. I'm a doctor, not a broker. I am truly independent. If there's ever a conflict or I'm doing something with somebody else, I will tell you. Nobody pays me to talk about their technology. No one gives me their stuff for free. I will say that I get special access, and sometimes after I bought something, I'll get additional access because I become friends with the proprietor. But nobody pays me to talk about their product, good or bad. And trading involves risks, and you alone are solely responsible. And especially in times like this, where the last couple of weeks have been tough in growth to make money, um, you have to be careful. And if you trade options, it's funny. The OIC will tell you how Options Industry Council how risky options are. A lot of options traders, including myself, think that they're less risky. But in times like this in the market, if you're in the wrong sectors or wrong industry groups and the market goes against you, you can get wiped out pretty quickly in options. So you have to be careful. So as much as I love options and I highly recommend learning about options, you need to read the OIC Industry Council work on the risk of trading and benefits of options. Be your own guru. I spend a lot of time talking about my influences. I'm not going to do that today. For those that are new to me, I started on the left with CanSlim. It was improved by Ian and Ron Brown, taken to the computer with HGSI software. Morales and Katcher modernized it with their Bible gap ups and pocket pivots. And then John Person, a great friend, trading partner, mentor, educator, software developer, now algorithmic trader, really made it more practical to me and told me how to make money trading. Van Tharp for money management, George Lee, whom I've had the honor of sharing the podium multiple times. And then somebody new, Guy Cohen. This is for those folks that perhaps are a little bit earlier in their trading, are looking for more help. And he's got some great scanners on his website and an interesting indicator called the OVI. I do want to call out that since I started another company in healthcare technology, I stopped doing my live events. Now, I really enjoy the live events because it gave me a chance to do what I like to do, which is sit in front of the room, be the star, and talk. But I also like to teach. Um, I do have the opportunity from time to time to get on stage when somebody else teaches. And so John Person has a 3-day event from November 30th to December 2nd this year. If you go to www.personsplanet.com, you can find out more information. There's a substantial discount through this weekend on the website, and also a free night in the hotel for several of you. The hotel is a Hilton Garden Inn. It's actually the nicest Hilton Garden Inn that I've ever been in. And it's a short distance from Palm Beach International Airport. I will do a pre-meeting event, and the way I've usually done these is if you are attending John's event, you'll get a discount to come to my event. If you're coming just for my event, you're missing out. Um, you'll pay a little bit more. I am considering a post-event as well, but right now we're going to plan it as a pre-event. If I get a lot of feedback that people rather meet Sunday instead of Wednesday, then I can certainly flip-flop within my schedule. So I'll look for feedback on that. You see my email address at the bottom. This time, John has asked me to talk about how I use the things that I do and merge them with what he does, especially in trading stocks. John has developed some pretty cool trading systems of late. Now, although he'll talk about this meeting having a lot to do with algos or algorithmic trading, I sat through the meeting in Vegas that he did, also on a similar topic. What was really cool was he doesn't just put up a system and show you how he makes money with his system. But what he does is he talks about the parts of the system, how he, what is a PPS indicator, what's a high close, low close doji, what's a last conditional change, the tools that he uses and the things that I use every day. And he shows how he was actually able to put the things that he teaches into an automated trading system and how it's very effective at making money. So you'll learn the background as much as you'll learn the tools on the strategy. I will teach you how I interact HGSI and John's tools to make money and how I take trades. If I do the program on Wednesday, I will try and give a basic background of HGSI and then move it up a little higher level during his sessions that I teach in. If I do it on Sunday, then I will probably do the more basic stuff during John's meeting and then push the learning on the Sunday event. Again, it can be Wednesday pre or Sunday post. Both work for me. I'll look for emails suggesting what people would prefer. John's program will happen no matter what. All I need is 5 people to do mine. And the reason I only need a couple people is I don't do these to make money. I do these because I have fun. And they've always been great events. And it'll be priced so that I don't lose money, but I don't do it. It's not my business to make money off you. What I need on a desert isle, I need trading software. I like TradeStation, Thinkorswim. You'll probably see both of those tonight. I also think Genesis is a great product, but I also recognize that's not for free. And most people I work with on the stock side don't use Genesis. It's usually running on one of my monitors all day because it's got some unique scanning as well as it has some great charting potential. On the analysis side, I live with HGSI. That's the program that I find most valuable for analysis from a speed and completeness perspective. EdgeRater, another tool that I use for analysis, but also supplements HGSI. I do use seasonality, take your choice, and then a lot of different websites, and I should add Guy Cohen stuff to that as well. Just a word about HGSI and my email address. I have no business or commercial relationship with HGSI. My email address is because for the last 15, 20 years, I've provided unofficial, unpaid support to HGSI. And I didn't want to use my work email, so I get hgsidoc@gmail.com. And that way people know who I am when they reach out to me. So it's only because I like the program and I want to support the proprietor. This is not a major mass market program where you're a number. This is a program that has a family of users. It's a growing family, and each one is trying to get individual attention. Email address, or excuse me, the website, highgrowstock.com. If you go under investing strategies, you can find hundreds of my videos as well as from Ron Brown. Ron has a different way of trading than I do, also very successful, and it shows how you can use the same program with different trading styles, which I think is great. And then the other thing, here's Gil Morales. He has some stuff on it as well and built into the program. And then the other thing here is the word free, 30-day trial. They don't even ask for a credit card. So I always talk about you need to know where we are in the market and that for so long we've been living at the top. Well, what do you do when the market starts to bifurcate, trifurcate, even quadricate, if that's even a word, and different parts are doing different things? It sure as hell feels like technology is here. Healthcare is about to go there, and energy and retail are down here. And so you really got to be careful of what you're doing in this market, and we can't treat the market this time as a single market. Now, perhaps this is just pure rotation and the market will go higher, but we also have to be concerned that we're just seeing some junk off the bottom in retail and energy before another big leg down, and we can't ignore the season that we're in. And one thing that one of the guys I like listen to, Dan Fitzpatrick, often says is that he's really teaching how to manage your risk. And this is a risky time. So if it's risky, then you have to look here and say, gosh, if I'm in risk, I should be raising cash, smaller positions, selling premium. And I think that's the smart way of doing things. I found over the last couple of weeks, I find something that's pulled back to support and looks like value, and I get my lunch handed to me. But if I'm taking small positions, um, risking 50 cents or a dollar, I'll live to fight another day. It's not a time to be a hero. Now, what's interesting is last week, I think biotech and healthcare was really strong and finances look good. This week, we flip flopped. Where is the strength? Well, clearly, look at industrials. Every one of these industrial plays is green. Huh. Look at home builders. Every home builder is green. That's interesting. Retail, predominantly green. Now, what's interesting is discretionary and staples were still weak on a weekly from a spider perspective, but they look pretty good as well. What looks horrible? The banks, especially regional, and technology is weak, and semiconductors. So just with this simple view in TradeStation, I'm able to see how the market is doing. Now, this is not fancy. This is something that John gives out with his indicators. I just took his indicators off. And what I did is I took some of the major markets and ETFs, and then the various ETF components that I want to follow. And it gives me a sense of where the market's going. All you need to do in any program is just create the sections of various different sectors or industry groups, and then you can watch them real time and get a sense of whether the market's moving one way or the other. Speaking of the market, this is a daily picture from my Thinkorswim account. In the upper left is the E-minis, in the middle is the NASDAQ futures, on the upper right are the Dow futures. The lower left, because I won't pay for TF to Thinkorswim, for $100 a month is the IWM, so it's an ETF, not the futures, the VIX, and the dollar. So it was painful last week, and we can clearly see the weakness in the NASDAQ. Now, you can't see it well here, but there's a doji on Friday. Doji's an indecision day, and it wouldn't be the first time that a market move stopped and held with a doji and then opened up the following day. Monday being a half day, pre-holiday day with probably light volume. I'm not sure if I'm banking on anything that I can count on Monday. If I look at the E-minis, I see it bouncing off the 50s and moving up. I don't think it got down to the 50. You can't see it well here. And the Dow is holding up on the 17-day moving average. If I look at the IWM, it had pulled back hard on Thursday and closed back at the 17 and is sitting on the 17. I think actually, if you look at over the last couple of weeks, the best movement's been in the Russell. The VIX spiked early in the week or on Thursday, ran right up to its descending 200-day moving average and came right back down, but it's clearly higher than it's been, perhaps signaling greater risk potential right now. And the dollar continues to do horribly. I guess Trump's strong dollar policy has right up there with his healthcare reform and tax reform. Maybe we'll see it, maybe we won't. In the weeklies, you can see, still in an uptrend on the weekly. The E-minis above the 17, the 50, and the 200. Even the NASDAQ, which had a new weekly person sell signal this week, sitting above the 17 weekly, as is the Dow futures, the Russell futures. So, the Russell is clearly the loosest. Like I said, it's had a nice move, as I'll show you in a few minutes. The VIX on the weekly is down near its lows, and the dollar you could see heading down, hopefully not to test the 200-day moving average. So when you look at it on the weeklies, and this is sort of the slide that says, take a deep breath. And, yes, the tech wrecked and healthcare got a cold. But is this market as bad as it feels? Only if you're overweighted in tech and in semiconductors, because we're still in uptrends. And then just to prove the point, on this view, I have across the top row daily, the middle row is weekly, the bottom row is monthly, and I have E-minis, NQs, TFs, NYSE, and the YMs. And just look at the monthlies. The monthlies are all heading up to the top. except for the NYSE, which is at highs, but the NYSE's had the least lower left, upper right appearance, and probably because of the energy conundrums that we've seen. Yes, the daily looks junky, especially on the NQs, but when you look at the longer term time frames, we're still in an uptrend. Now, interestingly, and see how well you can see it, I don't think you can see it real well, but on both the 30-year and the 10-year, rates went up this week. Um, so that's interesting, and maybe that's a good thing. That could certainly be good for the dollar. We know that if rates are rising, ultimately they'll be good for the banks, the regionals, and the insurers. And you notice that even on Friday, where rates moved up, they were weak. Um, could be bad for home builders, dividend payers, utilities, MLPs, and REITs, some of which were strong on Friday, despite the rate pop. So I think the rate increasing on Friday, I need more to prove it. It's still in a downtrend. It's just a retracement in a downtrend. But if the rates continue to go up, frankly, I think that's good. I think the concern is that will the Fed tighten appropriately speed? Is the economy better or worse? And what happens when they take away the punch bowl of all the quantitative easing? Now, the other thing to point out, and you could see sort of a separation between these two lines. The line that's pointing up is actually in white, and that's the AD line, and the line that's pulled back is the S&P 500. There's a bit of a positive divergence there, where the new highs, or the AD lines, not the new highs, the AD line is a new high on both the small and the large, even though the major indices pulled back. Now, to me, that's a positive for the market because typically I'll see the markets push higher and the AD start dropping in advance of a pullback. So is this an anomaly, or is this some evidence that the markets aren't as weak as CNBC sounds? From a breadth perspective, we actually moved up a tad on both the stocks above the 200 and above the 40-day. Breadth is good, certainly not overbought. On the new high, new low, we eased a bit, still in the upper third, but no pressure from this that says the market's got to turn back. And every time we get up near the top of this, we've seen at least short-term moves in the market. You don't expect that to occur from in the middle here. The daily and the weekly McClellan, we just talk about the weekly, sort of a zero line reject from above. And that's good because if you're long this market, that might be a bullish sign. You notice on the submission index, we have higher lows, but also lower highs. So that one remains to be seen which way it's going to break. Again, my interpretation here is that it's not telling me that this market's done going up. When it starts to break down, I get nervous. When it gets down to extreme levels, I know it's starting to go up. When the index, the oscillator gets to the highest point, I know the market's probably going to revert to the mean. We're sitting on the mean. And I was reading something put out by the McClellan website about how this is some of the lowest variation day to day that it's ever seen. And they were trying to come up with various meanings for it. Buckets, neutral. And again, let me just make a quick semi-commercial. If you don't know what the heck I'm talking about, if you email me at hgsidoc@gmail.com, I'll send you two different sets of links. One link will be to one of my live presentations, video and PowerPoint, which go over the definitions of everything I look at. The other will be a 6-pack of videos matching up with the different buttons in HGSI to help you in your learnings. This takes the S&P 1500, looks at each individual stock on their Bollinger Bands. This tells me that half are above the midline of their bands. And this tells me where they are in the band. So you're a little bit above midline is the average. But then I look at the number of stocks below or above the Bollinger Bands, and those numbers are very small. This is a neutral reading. Again, not overbought, not oversold. Hindi. I like the Hindenburg to watch because the Hindenburg gives me a clue as to whether or not the market is at high risk of rolling over. And we know that when you see multiple Hindenburgs, you start to get nervous. And again, in that explanation video, I go back and look at prior market large corrections and show you a plethora of Hindis forming. I look at the Hindenburg on multiple different vehicles, And I go back here to Labor Day or Memorial Day, the last big holiday, when it was interesting that we fired on both the NYSE and the NASDAQ at the same time. That hasn't occurred very frequently. Obviously, since that time, we've had a difficult market, but again, one that's held up on the averages fairly well. If I go back about 10 days ago, we had a couple days fire on the NYSE. I think these still tell me to be concerned about the market. If I go 3 or 4, another 2 weeks without seeing them, and I get 3 weeks since the last signal, I'll start to say an all clear. But right now, these tell me the market's still at risk. As the market's eased off the last week or so, the pressure on the Hindies eased as well. Market tone, let me specifically look at this column here, which is the Woody indicator. Green, it's time to buy. Red, it's time to sell. Yellow is chop. And we clearly have a more bearish posture. You notice this long, these are the kahunas in red, that every index had kahunas on, I think that's supposed to be, I can't even see the date, on Friday, Thursday rather, every major index had kahunas to the downside. What we need is a couple of these kahunas to the upside to flip us out of this. But right now the market tone is bearish. And if I look at the sectors, again, the same thing. It's a mixture. Healthcare and financials up. Discretionary, staples, utility, and technology down. And energy and industrials are neutral. Canaries in the coal mine. These are the FANG stocks, essentially, with a few extras. You got Apple. You got Baidu. You got Netflix. You got Google. You got Amazon. Facebook and Priceline. And you could see that they broke down on this week, and we'll see if they rapidly turn around as they've done in the past, like here, or are they going to go down and visit the 200-day moving average, which would be quite an impact on some people's portfolios. Now, these were not necessarily the leaders, the FANG stocks, although they get a lot of attention. I guess it helps when two of your stocks are $1,000 and seem to go up every day. But the big leaders in the market as of last week are the list on the left. And what I did is I put this list together because when the leaders are done, I need to know that. So you would think the leaders are done, but not so fast. We've had a relatively orderly pullback to the 17-day simple moving average. And that's why your leaders are not concentrated in one industry group. We only have 2 stocks per industry group. So did the leaders pull back? Absolutely. They had a mobile breakdown out of a squeeze. They had a couple kahunas to the downside, the index of the leaders. But notice the weekly bongo, which I put so much value in, is still green. So I think that we have a good chance that we bounce from here, but we will see. You can see how many times we've bounced off the 17-day moving average on the way up. Free parking is the 50-day moving average. Most leaders will pull back and bounce off the 15 from time to time in their uptrend, as taught by Ian. But strong leaders will do the same off the 17. So down but not broken. Know your news and earnings. There's actually a fair amount of news on Monday. And I thought unemployment might be pushed back a week, but it shows July 7th having the current employment situation. You got the ADP employment report on Thursday. Not much from a earnings week. So these are some of the things that popped up. I know on my stocks there's not much, but you have to know what's happening with your stocks. The judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. General market's holding up well despite tech wreck. As generals fall, breadth actually appears to be improving. Maybe that's a good thing. Large tech is approaching key support. Healthcare fading in light of congressional inaction. Rates rising as Fed and EU talk about removing the punch bowl. So, as I say in the bottom, time for caution exists, but there are signs of strength. The index is at the 17-day SMA, demonstrating that the overall leadership is holding on despite the illness in the Canaries. This is not time for heroes. Raising cash and remaining cautious is still in order. Usual top-down agenda, and on to the charts. So let's go into TradeStation and let's just look at the things I look at quickly every day. I call this my 5 points. It's really 6 points. Point number one, am I in a PPS buy or sell as indicated by the arrows? This is the NASDAQ. We are in a daily sell, a weekly sell, and a monthly buy. We've been in a huge uptrend, and these sells in the past have been short-lived. Okay, could it be different this time? Absolutely. I look at the color of the paint bar. This is something called the Elder Impulse Release. And if it's red, that tells me that I should not be buying. I should be selling or holding. If it's green, I can be buying or holding. If it's blue, it doesn't give me a signal. So I've got red on the daily, but blue on the weekly and monthlies. Third thing I look at, are there red dots on top or green dots on the bottom, which would be MACD divergence on top or convergence on the bottom, negative and positive. And you could see we had it on the weekly, which we worked our way off over the last couple of days, so there are none. The fourth thing, where are we within the auto envelope? This is here for a reason. You can track along it for some time, but when you get far below or above it, you come back. We're sitting on the bottom of the envelope with the doji. That's interesting. That is interesting. I also note, even though I don't have a signal here, I guess we're not yet at a lower low. I'll take that back. The next thing I look at is where are we at in the high jump bar. And a couple of weeks ago, I talked about the NASDAQ getting up close to 100 and that it was time for caution. We're not anywhere close to the high jump bar. And then the last thing I'm looking at are my bongos. The daily and weekly are in a sell mode. And we've been in a sell mode despite this buy sign up here. So NASDAQ weaker on the shorter than the long term. Not yet at extremes, but probably getting close to those. Take a look at the E-minis the same way. Weekly sell, but daily sell, but weekly and monthly buy. Red on the daily with a doji, blue on the weekly and the monthly. No dots on the top or bottom. In the middle of the envelope, 48%, and the weekly bond goes green still. ES looks stronger than the NQs. Let's look at the YMs the same way. Again, daily sell in red, weekly and monthly buys in blue. No dots within the envelope. 46% weekly bongo green. Still looks okay to me on the YMs. TFs, remember I said it's the strongest of late. It's actually in a daily buy signal in blue, weekly buy, and monthly buy. It's got no divergences. It's got a 38% in the daily and weekly bongo. So Russell actually the strongest, NASDAQ the weakest. And remember the NASDAQ futures are the NASDAQ 100, which are the large stocks, so not a surprise. Let's look at the dollar. Notice these green dots. These green dots suggest that there's some MACD divergence, that we're getting lower lows on the dollar, but not lower lows on the MACD. Now, this could be interpreted as a sign that the dollar is about to rebound, but you'll notice you can maintain this divergence for a long time. On the other hand, you are way below the auto envelope. That is more likely going to see a rebound. So daily sell, weekly sell, monthly sell. The dollar's in a funk. The bongos are all negative. We're about as low as you can get on the high jump bar, which is typically a time that you see a bounce. So I'm looking for a bounce in the dollar this week, but I won't estimate or jump on it until I actually see it. But the dollar looks weak as can be. Now, if the dollar's weak, then yellow metal, gold, should be super strong. And this is a little bit bothersome because gold is not strong. And it's in a daily, weekly buy or sell signal, monthly buy. The weekly bongo just went red, which is bearish. So gold looks weak. What else would I want to look at here? Let's look at oil. kind of textbook for me in that we've been in a downtrend for quite some time, and we got to really low down here on the high jump. I wonder if I could actually see what that is. Nope. Sometime I can make this. All right. So it's not telling me the high jump value. All right, let me see. One more thing I want to check. Um, when the high jump here, it got down to 0, the lowest high jump of 2 years, or 200 bars rather, and you saw what happened. So we have a buy signal on oil. We had a period of MACD divergence. We broke below the auto envelope. We're now green in a buy. On the longer term, we are in a sell still, weekly and monthly, and the weekly bongo hasn't turned yet. So this is interesting to me, and that probably supports why energy is a little stronger this week. All right, so that gives me a sense of the market. Then I open up my HGSI, go into Woodward and Brown user groups, going to go into Major Markets Plus, and then I'm going to rank them based upon price and volume. One day the most important, then 5 days, and then 3 weeks. And this is interesting because I'm not used to seeing semis and NASDAQ at the bottom with the NYSE mid caps and small caps at the top. That's a very strange looking picture, but it reflects what the market is doing. You can see volatility was up 11%, oil 7, gas 6, commodities with a big move up 5.5% with the dollar down. On the downside, over the last 5 days, semiconductors were down about 5%, biotech 3.3, NASDAQ 100 nearly 3%, the NASDAQ 2%. All right. Then I like to take a look at some of the components here. Take a look at the S&P 500, and what I'm going to do is move this over a little bit. And so I'm going to tell you, for newbies, I'm just going to give you sort of a quick tell you what's in this chart here. And we could use a little bit more. All right. Up at the top are my bongos, the weekly and then the daily. I use the weekly bongo as my buy-sell indicator. When the weekly bongo is red, I know the market is in trouble. When it's green, I should be long. Now, it's late to get me in and sometimes late to get me out, but you'll capture the majority of a move. When we're in chop, it goes back and forth. The daily bongo is a much shorter acting one, and if the weekly bongo is green and the daily bongo is red, it gives me a scan parameter to look for things that are pulling back. The third and the fourth column down are different ways of looking at the Hindenburg because there's been some changes in the indexes and I don't want to miss them. If I go back, I do this every week because it's so phenomenal. Look at 2006. Remember, I said 1 or 2 Hindis matter, but I'm looking for a family of them. Here's a family of Hindenburgs, and this led to a big pullback in 2006. Then we go down to 2007. We're in a nice run up in the market, and a little choppy. And then notice the Hindenburgs coming in here. Again, it's not just 1 or 2, and then the market sells off. All right. Then the market makes its way back up, double top, and what's coming in soon, we start seeing my friend the Hindenburg. And do not think that knowing what I'm teaching you, that this would make you nervous. Now, this day looks like it's a day the market's going to bounce the next day, but I've got a bunch of Hindis, and we can see what happens. So what the Hindenburgs did here is they gave you multiple chances to get out of this market. And whether it's when it stayed and failed at the 200, failed at the 200, when it broke below the 50, whatever is going to get you out, those Hindenburgs were pretty meaningful back then. until March of 2009 when we had this reversal and a break above the 50, and then before you know it, a break above the 200 in June, and that 200 now becomes support, and the rest is history. So I pay attention to Hindis. That's why I watch those. On the price chart, I have an 8-day exponential from Steve Bigelow and Rick Sadler, the T line, which in an uptrend usually is support, in a downtrend is resistance. Then I have simple moving averages in green, the 17, the blue, the 15, 200 is red. If you see a gray bar here, that's the industry strength, industry group. If you see dots in red and magenta and in green, those would be a PSAR. Down here I have kahunas. Kahunas are exuberant moves on the individual entity we're looking at, and it's more than 24 if it's shaded light, or 40% if it's shaded dark of a move of the Bollinger Band in a single day. And down under here are things called eurekas, which is a follow-through day in the HGSI world. So a bottom, a bounce off the 200, a kahuna, a eureka, and the bongo turn green. I mean, there's like a trifecta of why you would want to have gone very long on this as it broke above the 50. We don't see any phoenixes yet. So I look at the S&P 500, obviously in an uptrend. If I flip quickly to the weekly, very much so in an uptrend. If I look at that weekly bongo, it's in a green with a pullback on the red. No Hindis the last couple of days. It's had some kahunas to the downside, but still holding up okay. It hasn't died yet. I'm worried about it, but it hasn't died yet. If I look at the Dow Jones Industrials, I know it's right in front of me. Same picture, nothing else to say. Notice the Eureka will never change because the Eureka and the Phoenix are calculated on an index, not on what I'm looking at in the window. If I go and I look at the NASDAQ, obviously we expect to see weakness. Here's a NASDAQ composite sitting pretty much on the 50, a natural place. When I said tech is approaching support, this is a place where it's bounced multiple times before, but not always. If I look at just the NASDAQ 100, which is the big boys, which represent most of the NASDAQ, it's already broken down below the 50. Notice the Hindenburg has turned red on the NASDAQ 100 stocks versus the NASDAQ itself, also red, all right? And then lastly, the Russell 2000. Holding above the 17, everything is green. We said the dollar was weak. This is sometimes an easier way to visualize things. So let's find the dollar in the middle here. And you could see the dollar. This was weak here. It's continuing in a free fall. The weekly bongo's been green, red ever since we were up here breaking through the 50. It would have got you in late to the downside, but would have kept you in and caught much of the move. On the dollar, there's been kahunas to the downside. Dollar is just plain weak. The VIX, big winner this week, as you saw, with a spike and a fall. Now we're back in chop land, and not that different from where 6 months ago was the baseline, although it's been lower of recent past. And notice that the weekly VIX bongo has turned green. A VIX that is set to go higher, and I'm not saying that it is, but that's concerning, is not indicative of a strong market. But make its move. Don't just jump because you're convinced it's going to happen. Wait till it happens. Despite a weak dollar, perhaps it's because of concern about the punch bowl that's been driving the market inflation being taken away. Gold is now in a weekly bongo sell. Hard for me to go long in a weekly bongo sell, and you can see it sitting on the 200. Now, I've been relatively bearish on gold for quite some time, and I really spend a lot of time watching that bongo. Gold had a nice run up earlier in late last year, or last year starting in February, where let me go to weekly, that might be able to see it a lot better. Where you could see it had a sort of a counter trend rally here, and then it's just struggling since that rally to stay up there. Gold's a tough place, I think, to make money to the long side. in its favor. It's holding at the 200. Now, that's one thing about physical gold, but miners may not look the same. If I look at miners, they clearly look weaker, although they had a green box, but they're failed at the 200 multiple times. Very bearish. And then silver, which has some industrial applications beyond just being shiny and pretty, um, also looks more like the miners than it does gold. So that gives me a sense of the market. So right now, let me take a breath and tell you, if I'm looking at what am I doing with my money and my family's money, I'm seeing that it's not over. So I don't want to be short everything because I don't think we've got a sell signal except in the NASDAQ, and that could change quickly. But I don't want to be putting new money to work yet, and especially in tech. But I want to be ready. And I also don't want to be fully invested now because I think this market is, as I said, it's bifurcated, trifurcated. It's not done going down, but in some sectors and industry groups like energy, it looks a little bit more promising. So we have 174 industry groups. And by the way, it's much easier when it's in harmony, not when it's bifurcated this way. And if I look at the groups with upward momentum on the short term, I got 43. Downward momentum on the short term, I got 6. Insurance, electronics, specialty apparel, healthcare facilities, base metals, gold and silver, professional services. If I look at an intermediate term, 5-day down, I got 36, and I got 51. So when I have more stocks with positive 2-day and 5-day force than negative, that tells me breadth is improving or positive. So let's take a look at some of the stocks, some of the industry groups that are showing momentum to the upside. Let's look how many energy groups in the top 15. 1, 2, 3 out of 3. So most of them are, here's refining, number 28 is 4. Integrated is 5. So we got 5 of these groups are energy. The top 3 are energy. Auto retailers, that was interesting. I saw that on my top-down review. Diversified and regular banks. So even though banks look weak on Friday, regional and big banks made the list. And steel is showing up, 2 of them. That's interesting. In fact, let me take a pause. Here is last week. Last week, this is the year to date rather, so 6 months of data. It shows that the biggest returns, and this is the buckets, just like the bucket picture, the stocks that have the highest ERG, the ERG are earnings per share, relative strength, and group rank. You add the 3 together. To the right is the highest numbers. The highest ERG, it did pretty well, but some of the low ERG stocks outperformed. So junk off the bottom. If you look at fundamental values on December 31st of 2016, stocks that had the highest EPS rank have actually outperformed. Some of the stocks with no earnings have done okay. This is the scary one. This shows me that as of December 31st to now, lowest relative strengths have outperformed, and stocks that were distributing at the end of the year are actually outperforming. So this is junk off the bottom. Maybe it represents rotation out of Trump stocks. If I look at the last week, looks the same. This is the last week. What do I see? That the junk stocks are really outperforming the good stocks. And you could see here, high earnings per share and relative strength rank got clobbered this week. Hopefully it's a 1-week wonder. So that just gives me a little sense of what the market is doing. Close this down. So let's look at energy. Certainly off the bottom. Now you notice the 2 are above the moving average. I like to buy stocks mostly above the moving average. I've got a position now in Devon and Cabot. So let's just take a quick look at some of these. Now I'm going to change the picture some. Let me tell you what I just did. I took the top up here and I added the middle bar, which is distribution, and then force 13-day, force 2 days, the high jump bar with green candle lows and red candle highs, a bar for viable gap ups. I'll point one out when we see one. The mustard is squeezed. These are MOBOs. Here's that industry group. Here's my PSAR. These gray bars are bingos. Those are sort of the baby out with the bathwater signal. So when I start to see bingos, I look for signs of a bounce. You don't always see them. It can keep going lower. This here is a pocket pivot. Blue is good. Red is bad. The deeper the color, the bigger the degree. On the volume window, this is OBV with a moving average. These are my phoenixes in red and my eurekas in green. You notice more signals here because I switched from the NYSE as my source on the indexes to looking at the NASDAQ as the source. And then on the bottom will be the kahunas, and this is volume. So what do I see here? I see in a falling knife that had massive volume on Thursday, an OBV spike, a pocket pivot on Friday, and still got a ton of overhead supply and resistance to get through, but a bounce on Carrizo. Again, still has a ton of resistance and overhead supply to get through, but it looks like a bounce. When you have that much above you, it's hard to break through. Hess Corporation, same chart, moved a few more days, a couple of pocket pivots. Here's the index. Continental Resources, one of my long-term favorites, still has earnings per share growth coming in. In fact, you're going to see a turnaround as you're starting to see positive earning where you had losses. We're picking up on the revenue quarterly here as well. A lot of demand on this stock, same pattern, junk off the bottom pattern. Devon, same story, nothing more to say. I got attracted by its EPS growth, and I made money on this stock in the past. Notice it had a kahuna on Thursday when the market was so bad. APC, Anadarko, same pattern. EOG, a little bit less to make up. We're sitting right below the 50. And I said I bought some COG, so I want to keep going. That Pioneer. These are all the same pattern. Marathon Oil, Concho. So this one's got a better pattern, and this one's actually broken out, is approaching the recent highs here. So COG, I bought some very cheap $25 calls. I bought them when the stock was 23, so we'll see if I can make any money on them. It's hard to get, frankly, excited when you see stocks that are so deep, and then Diamondback used to be a favorite, but when you see this pattern, you know it could take a while to work its way up. You're going to have resistance expected at the 50 and the 200, but some of these stocks have some great earnings per share growth. And look at the, I don't know if it means anything. 3 of 16, 3 of 17. That's a 5,000, 1.5 times, more than that, 168% growth on revenue, huge growth on earnings. At some point, this multiple here of growth quarter over quarter, and this multiple, even if this multiple stays the same, 223, 327, 417, you're going to be looking at a stock that in 2 quarters, if it makes its numbers, is going to have a trailing 12 months of $4.17. Let's say the PE drops to 28. That's a $112 stock or a $25 move from here. I think some of these are compelling, but they're not without risk, and they're clearly in downtrends. Junk off the bottom. Midstreams, these have the benefit of benefiting from both the energy side as well as a big dividend. A lot of these will look this way, kind of sideways into the 200-day moving average. The 50, 17, 8 being below the 200 tells you it's been in a downtrend. A number of pocket pivots, huge volume on Friday, still a weekly bongo green, nice dividend, 4.7%. This is one okay. Here's Williams. I like this one because it broke above the 200. Pocket pivots and kahunas, a new weekly bongos green, 4% dividend, not much in the way of earnings. ETE, I own this one, also broke above the 200. Still weekly bongos down, a little bit better, but not great earnings, 6.3% dividend. Targa, further down in the pattern, 8.1%. MPLX, same, 6.5. So a second group that's kind of junky patterns, but with big dividends. Oil services. I used to have some Halliburton. Is it time to go back? Here is Baker Hughes. They had a big deal with GE after their deal with Halliburton fell through. They've been in a downtrend despite the positives around that deal. And this is in the way, but notice my Bongo Weekly went red at the top, and it's kept you out of this. Um, it's early. It might be the right time to get in. I may have thought the same thing back here, back here, um, back here. It's not without risk. Eventually, it's going to be the right place to go back in. Schlumberger, the big kahuna here, deep in its pattern. Halliburton, deep in its pattern. National Oil of Arco, deep in their pattern. So these energy stocks look like they're turning around because they've had a couple of up days. The price of oil's gone up. Maybe something's changed. There were less new rigs this week than there have been in past weeks. But my God, they're still ugly. How about automotive retailers? West Marine. Thought this would be more of a boat. Let's see. Boating supplies. But so we got a small dividend, sideways stock, moved a little bit, I guess, on Friday. I can't even see what it did. Let's see. Oh, it moved all the way up here with a Bible gap up. When I see that, I think either a big earnings blowout or they got bought. So it's more from the web. FinViz. I love this. Goes right to the stock. Obviously, you're not going to buy that unless you have a really good story. And that story, for me to want to buy that, I would think the story would have to be amazing earnings. But that move has got to be a takeout. Monomoy to buy West Marine. All right, well, that explains that. They're a big deal down here. Skip. Avis Budget Group, they had some kind of a thing of electric vehicles or something moving up off the bottom. Let's make this easier to see. Still in a downtrend. They've been killed, as this Hertz has been killed by Uber. AutoZone, positive day, multiple bingos. Is this done falling? I don't know. Man, can you believe this is the third most positive group? You notice all the stocks are up. That's why it's positive. 2-day force is change comparing 2 days ago to today, or today minus yesterday's close times volume. You plot that, you take the 2-day exponential. This has moved up a lot in 2 days. CarMax is the best looking of the bunch. Everything is green up here, small earnings per share growth. You know what? I showed you this was junk off the bottom week. This is all junk. Diversified banks. I have a large position in Bank of America. I've sort of pinch my nose, close my eyes, and ignore it. And come back. Where'd you go? And if you put this on a weekly, you can see it's had a huge move up. It's gone sideways. With raising rates, they're able to return dividends. I think people got confused with Warren Buffett now owning 7% when he converted some of his warrants. But pays a 1.2% dividend. That's going to go higher. Has some earnings per share growth. Unlike everything else, this is in the upper part, lower left, upper right. It's been basing forever. Is it time for banks? Well, it's time for Bank of America. It's time for Citi. Even nicer looking pattern. JP Morgan looks a lot like Citi. Wells Fargo. So is it time for banks? I think it may be, and that's why I've got a position in Bank of America. Which one you take is up to you. I'll probably buy some. If I get a pullback, I want to get some JP Morgan as well. Steel wall materials. This is iron ore. Things going on in China and China slowing. These things are always at risk, and a lot of them are in foreign countries like Brazil, Australia. Rio Tinto. It's nice to buy this off the 200. It's now moved up about $5 off the 200. Vale in Brazil, probably a decent time to buy if you believe in Brazil. Pays a 3% dividend. Schnitzer Steel. So some of these raw material steel stocks show some interesting. Footwear and apparel. Nike had great earnings. I'm sure that's bringing up this group, although the average is quite a bit ways down. So there's something here. I mentioned retail showed some strength. Much of it's probably Nike, this Bible gap up from 52, 53. closing at 59. That's a huge move, about a 10% move in one day. VF Corp, a little bit more orderly move. Bunch of pocket pivots, looks interesting. Ralph Lauren, not by me. Hanes Brands, again, long-term downtrend, just broke above the 200-day and held it. That might be one to be interested in and looking at. PVH, a little bit nicer breakup when we're on the 200 and broke out. Level breakup from a squeeze, Bible gap up, continues to move higher. So these last couple look a little bit better. Under Armour showed up on a bunch of my screens. I just don't see it yet. So far the banks and those apparel footwears looked better than anything else. The energy is clearly in steel junk off the bottom. Specialty chemicals, one of their input costs, are related to energy, with energy prices being cheap. That should help them. Here is Chemours Group CC. I like this chart for a number of reasons. It had a kahuna on Friday, still in a downtrend, good earnings per share growth. On the weekly, looks like it's a flag and a reversal day. This one I'm going to be watching this week. So how would I play something like this? Well, I certainly have to expect it's going to fail at the 50. The PSAR dot is right below the 50. I probably wouldn't touch this stock until it closed or traded above that PSAR dot in the 52. I think this is one to watch, and it's on my watch list. Tronics, similar pattern, two kahunas, sitting off the 200. I think this is a low risk opportunity. You could buy it here at 15 and a quarter, and then don't let it get below the 200. Still a pretty big range there, a small dollar value, but percentage wise probably 15%. So there's more risk than I thought. But that looks like a low risk buy here. Schulman, don't know anything about this. Big move on Friday. So a couple of specialty chemicals look interesting. And then regional banks. Sometimes it's hard for me to sort these puppies out. So I'll look at a couple. Not similar to the big banks. Nice move on Thursday and Friday. This is Regions Finance, Huntington, KeyCorp. If rates rise, these probably benefit even more than the larger banks. What I often do on this group is I just say, forget it. Show me KRE. KRE is an ETF of regional banks, and it'll probably look just like that stock. So one way to play these is also ETFs. And then lastly, in the top 10, steel producers. I think we started talking about this earlier in the week or last week, maybe 2 weeks ago. So we got ArcelorMittal pulled up into the 200 and paused, has a doji on the 200 and a pocket pivot. The weekly bond goes red, the earnings suck. Hard to get excited here, but if it breaks above that 200, it's interesting. Steel Dynamics has broken above, but it's sort of at a place it likes to reverse. Worthington had good earnings come out, and you can see the result of that had a kahuna, a bunch of pocket pivots, broke above the 200. The weekly bongo is green, pays a small dividend. This might be a way to play steel. I suspect the weekly is going to look ugly, but let's see. Well, pull back to the 50, kahuna, pocket pivot, everything is green. I like Worthington Steel, and again, the earnings are out. Next earnings are not to September. I have played a little bit X. And X, obviously, further down in the pattern. I like Worthington more than I like U.S. Steel here. So, I'd like to say I showed you some great stocks, and it's time to get long and go for it and buy everything in sight. It's not time for that. I think when you see that even in these leading industry groups, the stuff looks kind of junky, that's got to tell you something. To the downside, just very quickly, PC insurance groups. See what the weak stocks look like. And these may be stock groups that have been doing well that over the last couple of days are starting to turn down. So here is Arch Capital. This might be an interesting stock to short. OBV is broken down. It's failed at the PSAR dot. It's heading down. Weekly bond goes red. The weekly still has support here, but that's about $7, $8 away. That's Arch Capital. XL Company, too early to short, still in an uptrend, just a 2-day pullback. Allied World, the same. AmTrust Financial. So weak the last couple of days, but only the first one is one that I'd even put on my consider shorting list. Consumer electronics, Fitbit, too cheap for me to think about to the downside. GoPro, too cheap to think about, so nothing there. I'm always looking for potential shorts, especially in a market like this. Specialty apparel, I'm going to DSW today. That'll help the stock. This is the kind of stock I like to short. Runs up to resistance and fails, runs up to resistance and fails. It's a cheap stock, although you can probably make some money on shorting that as well. Finish line failing at the 50. Problem with these are they're cheap stocks. So those are what weak looks like, and you can see the difference between weak and strong with this ranking is just the last couple of days. Now, the other thing that I like to do within HGSI, you'll notice there are these things called smart groups. And several of my favorite patterns are done for you, like pull back to the 50, moving average with a kahuna. So these are the stocks that met that criteria. If I hit warehouse view, it'll open them up in a spreadsheet view. And let's rank them by the same 2-day force. I don't want to do bonds, so let's do this. Let's go down here. All right. So by definition, these should be pulling back to the 50-yard line and have energy coming in. So here's a stock, uptrend sideways, sitting on the 50 and had a kahuna. Rockwell Automation, that's certainly probably the best looking chart I've seen since we started. I'd like to see it prove that it's breaking out and not just going sideways. Brandywine Realty Trust, pull back to the 50, kahuna, pocket pivot, everything is green, makes a lot of money. Dividend yield 3.7. That looks pretty interesting. Eaton Corp, electrical power equipment, uptrend sideways 50, 3 kahunas in 7 days, a pocket pivot, green, mobile breakup from a squeeze. That looks interesting. Time Warner, I don't know what's going on here, but sideways, multiple pocket pivots and kahunas, turn green on the bongo. I just don't know what's going on with Time Warner from a company perspective. I thought there might be something. So we go down and look at the news. All right, so AT&T is buying Time Warner, so we're done with it. Innovative, no. Uptrend sideways to the 50, multiple pocket pivots, a kahuna, everything is green. So using my smart group scans, how about squeezing with a PSI reversal and close? This is some of my favorite patterns. In this pattern, the stock needs to be in a squeeze, and the price had to close right below the PSAR dot. So here's DH Horton, one of the home builders that's showing some strength. Pocket pivot, kahuna, here's price, there's a PSAR dot mobile breakout from squeeze, and it's in a squeeze. Here's a stock that's ready to break out. CH Robinson, too far down in its pattern, but it's sitting with a kahuna, it's squeezing, and it's right below the PSAR dot. American Airlines Group, uptrend, pullback right below the dot. This is getting close to a buy. In a squeeze. I'm looking for a perfect one. Gentex. You have to be a little careful because a lot of these will be takeovers. All right, so that's a couple of scans that I like. Let's say you're a pocket pivot fan or a Bible Gap Up fan. These were the ones that had a Bible Gap Up on Friday. We looked at Nike and West Marine. We looked at all these except for Parkway Inc. Big move on Friday. And whenever I see something like that with that much of a move, I'm always going to go more info from the web. go down to FinViz, and I don't chase around stocks that are already being acquired. It's another sell. Okay, it's being sold. So I always like to get near the end and show you what I'm doing this coming week. I think you can tell that I'm being cautious. I hope you can tell that. I have a lot of stocks that I'm going to be watching. And here was my buy watch. First, let's look at industry groups. I'm looking for biotech to potentially bounce, but if you look at the choices here, there are a lot of, that's not my, hold on a second. Is that my buy watch from this week? Let me just look. Just make sure I'm in the right week. I think so. Nope. Hello. Hold on a second. Let me do some cleanup here. I thought those didn't look right. All right. And now I'm going to import my buy watch. Now I'll show you my buy watch for this week. Everything else was fine. I just was looking at the wrong. So these are some of the stocks that I'm going to be looking at this week. You can see there's a lot of energy. There's exploration and production. Most of these we looked at, including that Diamondback, which I think has a lot of appreciation potential. There were a number of MLPs that I looked at. On the refining piece, liked Phillips 66. And again, not a great pattern. Let's throw it on a weekly. And you can see it's been sideways, but it's coming off the lower part of its Darvas box with a couple of weekly kahunas, as well as a bunch of daily pocket pivots, and it pays a 3.4% dividend. So aircraft parts, I showed you Rockwell columns. Spirit Aero Systems was another pattern that I liked. Pull back with a kahuna here, mobile breakout from a squeeze. Some auto parts. We've talked about auto being strong. Just leave this up here for a couple seconds. American Eagle Outfitters. I was surprised when I saw this chart. I don't know what I was surprised about. Never mind. I was on the person stuff. I think I saw, let me see the weekly. Yeah, I had a high close doji here on the weekly chart, Mobo breakout. And again, I looked at if retail's getting stronger, where do I want to be in retail? This looked interesting. I'd rather not touch it until it gets above the 50 because that's too obvious a point to fail. So that was one of the retails I looked at. I really want to find some retail because retail looks like it's improving. Hard for me to get that excited. And then Under Armour, it's not the leader. You saw a nice move by Nike. It looks like we've stopped going down. We're right below the PSAR dot. You see the industry group here is strong. Earnings are not to July 25th. So Under Armour I might look at as well. When I look at the stocks that I picked and the stocks don't look that great, it just tells me it's not a great time to be shopping for the long. The other thing I'll tell you is sometimes when it feels bad, it's the best time. Here's United Rentals. This is an oldie but goodie. I used to have a huge position in this, and then I sold it and it died. And then it ran back up and fell back. This is the weekly. Looks like it might be an interesting buy point. Still in a bongo red. We broke above the 50 decisively with a pocket pivot this week. And then the other one, last I want to show you, see if I can remember what it was. Yeah, I guess I'm good. Here's one of my favorite stocks, charts, not stocks, charts. It doesn't make money. That always bothers me. Lower left, upper right, medium from a tightness, pocket pivots, kahunas, broke out on Friday. Everything is green. This is TrueCar, TRUE. All right, on that note, let me just go back one thing before we say goodbye and just remind people what I said about John's meeting. John does a fantastic job in these live meetings. He puts his heart and soul in it. He's definitely gone into the how do you automate his tools. I kind of like that because if he can automate them, it just validates how great they are. But he really talks about what goes into the automation and what the tools are. And I'll be trying to bring it to stocks for those people that are looking for top-down investing. And I'll have a chance at the podium on several times as well. So love to see you. I am curious about Wednesday pre-meeting, or I should put, or Sunday post-meeting. Do you want the prereqs on Wednesday, or do you want advanced on Sunday? And I'm pretty open on which way I'll do that.